Good afternoon, traders. It's Bill Baruch with Blue Line Futures. It's your daily midday market minute. Do we have a recession trade building? But before I get to it, if you're watching this on YouTube, please click the link below and subscribe. Like and subscribe. And if you're watching from our website, there's also a link below to direct you to YouTube, and you can subscribe that way. We'd love you to follow us. We'd love you to help us build our following. All right, let's get to it. That's the question here today. And I asked it on the Morning Express. Is this a recession trade building? We saw the equity market trade lower yesterday and a trade lower again this morning. So if you're gauging the recession trade off the equity market alone, I don't think we're seeing that yet, because ultimately we're holding support so far. The S&P and the NASDAQ, they're really just trading down into the opening bell range, which is now support from Friday, the last day of the quarter. We're also seeing a rotation really take place. Maybe Friday, maybe last week in general, that final week of the quarter was a little window dressing, and that was a bigger tailwind to tech. So maybe there's some profit taking coming out of tech right here. But also some of the big names that we've seen down here in recent days, a Deere and a Caterpillar, which I cited on the Morning Express. Some of those names, I mean, for Deere, record highs in quarter four. Caterpillar, record highs in January. So there's maybe more of a rotation taking place now that tech is really starting to move. I mean, if you were underweight tech, you underperformed pretty much last quarter. So you might be seeing more allocation moving in that direction coming out of industrials. Yes, we've seen Atlanta Fed GDP now revised lower. It's 1.5% for quarter one. We've seen ISM non-manufacturing coming below expectations today, but it's not overall. It's not contracting. We're just expanding at a slower pace, which is really should be more of a Goldilocks scenario. Prices paid in the services sector, the lowest level since November 2020. Jolts earlier this week. I mean, it's been just resilient. It's been too high, and the Fed's been wanting to see it come down. So it was below 10 million jobs released yesterday, below 10 million jobs for the first time since June 2021. So these data points, they're not falling apart. I mean, still growth. We're not seeing recession numbers in the 1.5% GDP, but it's coming in a little bit. And I think what it is we've been talking about it. You got this, bring out your 2019 playbook, and that's all about tech. The NASDAQ finished up 40% in 2019. Now, I'm not saying the NASDAQ's going to go straight higher from here. It's digesting its gains. And I think the equity markets, they haven't done anything wrong. So if you're gauging the recession trade just by what we've seen in the equity markets, I think that's there's not enough here to say that yet. But are we going to see growth continuing to trend, continue to weaken? Well, maybe OPEC Plus. Maybe they were a little worried about that in the news and cutting production on Sunday because they're worried about demand if this recession takes place here across the globe. But there's definitely some political jabs there. So, I mean, overall, it's the first couple of days of the quarter, and this leads into non-farm payroll. I think it's profit-taking. I think the equity markets are holding support. All those levels of support are highlighted in the Morning Express, and we haven't even gotten down to our rare major 4-star support levels. So go check it out. But in the thought of profit taking, remember the market, the actual securities market is closed for non-farm payroll on Friday. So there's just some jockeying for position going into it. Now, what is the bond market telling us? We are seeing the 10-year yield at the lowest level since September, 3.3%. We're seeing the bonds, futures at a continuous chart, trade to new highs. Highest level, not new record highs, of course, but the highest level since September. So we're seeing the bond market tell us something, but at the same time, it's just taking the wind out of the sails of the Fed expectations. Right now, with this meeting about a month away, the 56 or so percent probability that they only hike or they don't hike at all, and that's down from a 58% probability that they hike 25 basis points. So we've seen it flip back, and then furthermore, there's a about a 65% probability that they cut rates by the end of the year by 75 basis points. So I think the bond market, if you're looking at the bond market to tell you that there's recession, I think it's just digesting the Fed. Now, I think there is a probability here that we could go into a recession, but there's not enough evidence right now. And if you look at the crude numbers today, I think that they're exuding strong demand. We saw drawdowns across the board, really, and that's with net imports increasing. What was it, 1.1 thousand? Was it 8 million barrels? That's what it was. 8 million barrels on the week. 1.1 1100 per day, 1,000 barrels per day, and 8 million on the week. That averaged in, I mean, you would think that that would encourage a build. We have imports that large, but we're getting draws in gasoline, draws across the board, seasonally bullish time of year. And we have gasoline up 8 cents on the day today, leading things higher. I mean, you got a bounce back in Marathon Petroleum. So listen, I think it's just more of a wonky market. Start of the month, get a repositioning, and crude oil's held pretty well. Copper may be the only thing that's concerning, but if we move on to the metals here, let's talk about copper first. I mean, I'm sitting here, I'm buying copper today, and I'm keeping my wrist tight on it, but I'm excited about copper as the year unfolds. I don't think we've seen the China impulse yet as they really reopening. Yeah, the reopening narrative was taking place at the turn of the year, but I think that from a demand perspective, they're reopening through the middle part of this year, the public getting out. So I think that copper could bring some good value at under $4 right now. And then we're really just testing into support, aligning with the highs from November and the breakout in January. And you may have an inverse head and shoulders building if today's low holds. So I think copper, which is really the only thing that, in my mind, on the week that's giving us that recession vibe, then it's actually pretty constructive of a technical chart right here, and a pretty constructive future looking from the fundamental side. Yeah, gold is trading higher and silver is trading higher, but yeah, the Fed's slowing. There's some banking fears out there, and I think that gold is on the verge of a potential breakout. I highlighted some levels in the Morning Express, some big levels of resistance. Check them out. They all align with some of the closing highs, settlement highs, and weekly settlement highs going back to those that August 2020 and March 2022 move. So there's a lot of resistance levels overhead. I also highlighted on the Morning Express some fresh resistance in silver. Keep an eye on all that. But this all leads into non-farm payroll on Friday. I think this data this week, I'll finish off saying, I think the data this week is more Goldilocks than anything. It's exactly what the Fed wants to see, and it's nothing to be really scared of, but it does move into the jobs number, the non-farm payroll on Friday. That's going to be the big one. Our team is here to help tomorrow. Give us a call. We're here to help, 312-278-0500. And remember, futures trading involves substantial risk of loss and is not suitable for all investors.